Yo, brainrots, welcome back to another video. Today we will be discussing something related to economy, something related to crypto. I know I talked about stocks and crypto in a long time, so I thought that maybe I should. So I thought that there is this one thing, one factor in the economy in all the markets. It's that a thing that most people ignore. It's liquidity. Now you see, most people they think that it's very hard to understand what liquidity is. But today I am going to prove to you the liquidity. I'm going to explain you with examples and everything. So let's very easily, very simply. So you will, I hope you will enjoy. So let's start. Now imagine you have two items. Both items they're worth $100. Okay. Now you sell your first item in 5 seconds. Okay, 5 seconds, very fast. The second item, it takes you 6 months to sell. You see, there's a very big difference in time, 5 seconds and 6 months. That is a lot of time difference. And this time difference, it is called liquidity. Most people, again, I'm telling you this again, they ignore this factor in all trading markets. But in fact, liquidity controls every single market you can think of, from banks to stocks to crypto. It is everywhere. So first I'll just give you a simple textbook definition so you can understand. If you are taking notes, you can write it down. It is okay, so the simple definition, it is how fast you turn an item into cash, an item in your hand, how fast you turn that item into cash, but without losing any money. You have cash, you can buy food right now. Right now, go to the supermarket, go to any market, go to any shop, buy food, buy bread, buy meat. You can buy it. Cash, it has the highest liquidity possible. Okay? Now, if you have a house, you normally cannot buy food or anything like a car from it. You cannot buy bread from with a house. Sure, some people will accept to trade, but you normally you will it will require that you sell the house to get money to buy the food. Okay. Now some examples. Let's say imagine a room filled with people. Okay, filled with people. They're all sitting on chairs, and you walk in. You walk in to sell a phone. Okay, you walk in to sell a phone. Five people they want. I mean, there's a lot of people, a lot of demand. Five people they get up instantly and offer you full high price. Some person even offers you double the price of the worth of your phone. Okay, this room it has very high. It has really high liquidity. Okay, over in that room over there you can sell your phone very fast. So it has high liquidity. Now picture walking into an empty room. There are two people sitting on the chairs, and what they don't offer you full price. Let's say you have an iPhone or Samsung, anything. They don't offer you full price. Instead, they offer you half price because they know you have no other option. They offer you half the price of the worth of your phone. You have no other option, so you have to take it. This room has low liquidity. So you see, now you can see that liquidity it depends on the cash, on the money, not only cash, but on the money that is waiting for you all the time when you are selling something. The cash that is waiting for you. That's okay. Now let me tell you how it works in the traditional markets. Markets they use something called a dev book. Okay. Now this you can imagine there's like a digital pawn shop. A digital pawn shop. there there is a seller and obviously there is a buyer. Now a seller he sets a price of $10 of whatever he wants to sell. Let's say a calculator. He wants to sell a calculator. Okay, $10, and he lists the price. Now people will come and they will offer their own price. They will bargain or whatever. Now a buyer comes and he offers $8 instead of $10. He offers $8. and the seller, neither the seller, he wants $10, so he will not accept, and the buyer, he will not buy. Now if there are no buyers, and the one who's selling the calculator, he gets stuck. His his offer, he it gets stuck, and if there are no buyers, he will probably not be able to sell it, obviously. This is how it works in the traditional banks, where people come and offer you money, offer you liquidity. And this is how it works in traditional banks and stocks, market stocks. But crypto, they have invented a brand. In crypto, there is a brand new, entirely different way from that. You do not have to wait for a person. Okay, you trade not with people, but with code. People, you can say that, okay, you can say there is a digital vault. Okay, a digital vault where people, they put their cash. This is called a liquidity pool. Okay, now pool, you can imagine, this pool, you can imagine, is like a vending machine. You put token A inside and token B pops out immediately. Now that token A, token B can be anything, but it pops out instantly. There's no wait for buyer, there's no wait for any checking, there's no nothing. Okay, and why is there no wait for buyer? Because that vault, it is already filled. Okay, and who, now you must be wondering, who pays the money for the vaults? How is this filled? Why is the vault filled right now? Like, who put the money inside there? Now you see, who puts money? Those are regular users. Every time someone uses the vending machine, okay, the vending machine I just mentioned, there is a fee which is detected, and that goes to the people who supplied the cash, that goes into the vault, in simple words. Now you see, the pool size, it matters a lot as well. It changes the whole picture. Now imagine pouring a large bucket of water into the ocean. How much do you think the size of the ocean is going to change? Not even 1%. Barely. Unnoticeable. Now imagine pouring a bucket of water in a coffee cup. The cup will overfill. Yes? Now big now you can see in the first one where you put a big bucket in an ocean, there is no change in price. This is called a deep pool. Okay? Uh the exact word, a deep liquidity pool. Now there, when there is no changes price, even with very big trades. Now with the cup example, you can see if one sale, one big sale, one big buy, one big trade, it can crash the entire price. So the pool size, the liquidity size matters a lot. Okay. Now to wrap up, you should just remember one rule. High prices, they are nothing without real cash behind them, real demand behind them. A person, okay, let me give you another example. You see, paper numbers, they show you what the worth, what it looks like it's worth, what something looks like it's worth. What do you think this is gonna worth? Tell me in the comments. And liquidity, it doesn't show you what it's worth, but it shows you real cash. Liquidity shows you the real cash behind something. So high liquidity, it means that your trading is wide open, and low means that your money is locked behind a locked door, you could say.